Hi, it's Jacob, and since I started this playlist, my goal was to make other people a whole ton of money and explain it in a way that's easy to understand. So today I share with you my strategy, and it's part of the 0.01% of investment knowledge that's out there, and it's honestly all that you really need to know. If you had $100,000 and you invested over 65 years and you returned 11.8%, you would have $140 million. If you had that 11.8% and bumped it up to 18.9%, you would have $7.7 billion in 65 years. The key learning point here is that the sooner you get started, the more money you're going to make. And I know a lot of people don't have $100,000, but if you take $10,000 and you look at those total dollar returns, just take off a zero. It's still like $14 million. It's still $700 million. That's more than enough for most people. So if you want to get these returns, step one is to buy small companies. People often ask me, small companies? Why would you buy small companies? Well, the reason is because small companies grow faster than medium-sized companies, which grow faster than large companies. If you think about it, is it easier for a small company to double its revenues, or is it easier for a giant company like Coca-Cola to double its revenues? People also ask me, aren't small companies more likely to go out of business? While it is true, the companies that we're talking about that are small have a market value of between 500 million and 2 billion. Even though they're called small caps or small companies, they're still massive companies. So idea one is buy small companies. They grow faster. Idea two is buy all the boats. If you've ever seen the show Deadliest Catch, basically they're these boats that go out into the middle of the ocean. And what they do is they go crab fishing. It's called crabbing. And what they do is they send these fishermen on these boats, and there's these 20-foot waves, and so many things could go wrong. Somebody could die, multiple people could die, they could go fishing and get no crabs, and worst of all, their entire ship could sink. And so stocks are the exact same way. They have a lot of risk and a lot of reward, especially these small companies. Here are a few companies that got hit really hard, and you can see just how fast you can lose your investments. So back to the Deadliest Catch analogy, when you see these boats going out, it sounds really dangerous. But what you don't know is that for every crab that they get like $1,000. And sometimes they bring like hundreds and thousands of these crabs. Sometimes they'll bring in a boat and it'll be worth like $1 million. And so you have to do the exact same things with your stocks. What if you didn't have one boat, but you had 200 boats, or 600 boats, or 1,000 boats, and you sent them to all different parts of the ocean? If you do that, yes, you'll have a few boats that sink, a few boats that lose lives, and a few boats that don't catch any crabs. However, on average, you still make a lot of money. So idea two is buy all the boats. Diversification reduces risk. And you might have heard that word diversification. That's exactly what we're doing here. So just a quick recap. Number one is buy small companies. And number two is buy all the boats. And idea three is don't get off the roller coaster. And what do I mean by that? It means never sell. The big money in investing is not in the buying and selling. It's in the waiting. Okay? I'm going to say that again because it's so important. The big money is not in the buying and selling, but in the waiting. Of course, I'm a logical person and very analytical, so here are some numbers to explain my rationale. JP Morgan recently did a study, and they tracked the stock market between 1995 and 2014. And what they found was in 20 years, if you missed the best 10 days of the market, your return will have dropped from 9.85% to 6.1%. The difference between 6.1% and 9.85% doesn't seem that much. It's just 3.75%. But think about it this way. If you had $100,000 and you invested it over 65 years at 6.1%, you will return about $4.5 million. If you had $100,000 and instead of returning 6.1%, but you return 9.85%, you return about $44 million. Okay? $4.5 million or $44 million over 65 years. So that small 3.75%, yeah, it's a big deal. So idea 3 is don't get off the roller coaster. Do not sell into panic. So just a quick summary, idea number 1 is buy small companies. They grow faster. And what we're going to do in the strategy later on is I'm going to show you which small companies to buy. Number 2 is buy all companies, or buy a whole ton of companies, 600, 1,000 companies. And later on I'll show you how to buy an index, and specifically certain kinds of indexes, so that you can diversify your risk. And idea number 3 is never sell. If you sell and miss just 10 days of the market, you are not just shooting yourself in the foot, you are shooting yourself in the face. That was a pretty dense video, so if you have any questions, make sure you comment below. Other people are going to have the same questions, and I really want to help to make as much money for as many people as possible. So definitely don't hesitate to do that. Of course, you can always call me if you are feeling shy, or if there's something that you still don't understand. Thanks for your time, and see you in the next video.